Welcome to our deep dive on the HSA tax trap and how to avoid gambling with IRS penalties. In this video, we will unpack HSA eligibility, the most common mistake that triggers penalties, and the exact steps to fix excess contributions before they become expensive. To begin, let's set the stage with what HSAs are supposed to do and why eligibility rules matter so much. Then we'll move into real-world consequences and fast solutions. Here is today's roadmap. First, we'll summarize why HSAs are so powerful. Next, we'll clarify the strict eligibility rules that often trip people up, and we'll explain how excess contributions occur and why they lead to penalties. After that, we'll walk through the fast fix known as a return of excess contributions, followed by the tax forms you must use to document everything properly. We'll also cover key deadlines and potential penalties. Finally, we'll wrap up with an action plan and a couple of quick quizzes to reinforce the learning. Now, let's transition to why HSAs are popular in the first place. HSAs are often celebrated for their triple tax advantages. Contributions can be pre-tax or tax-deductible, growth is tax-free, and distributions for qualified medical expenses are tax-free. However, there is a crucial catch that many savers overlook. Eligibility is binary and strictly defined. If you're ineligible and contribute anyway, you trigger a classic tax trap. With that in mind, let's smoothly shift into the rules that define eligibility so you can see how the trap is set. Let's define HSA eligibility clearly. To be eligible to contribute to an HSA, you must be covered by a High Deductible Health Plan or HDHP. Additionally, you must not have any disqualifying secondary coverage, such as a general-purpose FSA, or certain Medicare coverage that provides first-dollar benefits. Eligibility is binary. There is no partial eligibility. You are either eligible or not for each month. Self-employed individuals and small business owners often get tripped up by plan structures or unintentional secondary coverage. With eligibility clarified, let's move to the tax trap that occurs when ineligible contributions are made. If you contribute to an HSA when you are ineligible, those dollars are classified as excess contributions. Excess contributions incur a 6% annual excise tax for as long as they remain in the account uncorrected. The only proper way to fix this is to request a return of excess contributions, often called an ROE, from your HSA custodian. Importantly, the ROE must remove both the original excess principal and any earnings generated by that excess amount. Delaying action leads to repeated penalties each year the excess remains, which increases the long-term cost. Next, we will transition to the step-by-step fix so you know exactly what to do. Here is the fast path to fix the problem. First, confirm your HDHP status for each month to determine where you are actually eligible. Next, calculate the total excess contributions that correspond to the ineligible months. Then, contact your HSA custodian and formally request a return of excess contributions. Be sure to specify the tax year and the amount of the excess, and instruct them to remove the associated earnings as well. Once processed, receive the distribution and retain all documentation and confirmations. Finally, coordinate with your CPA so that the reporting is accurate across the necessary forms. Now, let's transition to the exact forms and where each one fits in your tax return. This table maps each critical form to its purpose and timing. Form 1099-SA confirms your return of excess contributions distribution and shows the taxable earnings. Form 8889 reports all HSA activity and reflects your corrected contribution total. Schedule 1 is where the earnings portion from the ROE becomes taxable income in the year you withdrew it. Form 5498-SA shows the total contributions for the year, but it often arrives after the filing deadline and is primarily used for records and verification. With the forms aligned, let's visualize the process so you can see the flow at a glance. This flowchart illustrates the corrective journey. We start by checking monthly HDHP coverage. If ineligible months exist, we calculate excess contributions for those months. Then we contact the custodian and request a return of excess contributions that includes both the excess principal and associated earnings. After the custodian issues the distribution, we receive Form 1099-SA and use it to report earnings on Schedule 1 and HSA activity on Form 8889. Throughout, we keep Form 5498-SA for records. If instead, we determine that no ineligible months exist, we simply continue normal HSA contributions and end the process. Next, let's examine how information moves among you, the custodian, your CPA, and the IRS. This sequence diagram shows data movement. The taxpayer requests an ROE from the custodian. The custodian processes the return, sends the distribution and confirmation to the taxpayer, and files Form 1099-SA with the IRS, while also sending a copy to the taxpayer. The taxpayer provides the 1099-SA and contribution history to the CPA. The CPA then files Form 8889 and Schedule 1 as part of the tax return. The IRS processes the return. Later, the custodian sends Form 5498-SA to the taxpayer for records. With roles and documents clarified, let's lay out the timing and deadlines that are critical to avoid penalties. This timeline maps out the calendar. From January through December, eligibility is determined on a month-by-month basis. In January and February, you identify any ineligible months and calculate the excess contributions. By the tax filing deadline, typically mid-April, you should have submitted your ROE to the custodian and received the 1099-SA. In April, you hand documents to your CPA for filing. After filing, often in May, you receive Form 5498-SA and keep it for your records. Importantly, the earnings component from the ROE is taxable in the year the withdrawal occurs. Now that we have the timing, let's test your understanding with a quick quiz. Question: if you are covered by an HDHP but also enroll in a general purpose FSA, are you eligible to contribute to an HSA? Options are: A. Yes, because an HDHP is the main requirement. B. No, the general purpose FSA is disqualifying coverage. C. Yes, but only up to half the limit. D. It depends on your income. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is no. The general purpose FSA is disqualifying coverage. Even with HDHP coverage, a general purpose FSA generally provides first dollar coverage and renders you ineligible for HSA contributions for those months. Now let's continue with how the earnings portion of your ROE is reported for tax purposes. When you request a return of excess contributions, the earnings on the excess are taxable in the year you withdraw them. These earnings must be reported on Schedule 1. The amount is confirmed by Form 1099-SA, which the custodian issues. Do not confuse an ROE with a tax-free medical distribution. The earnings component is taxable income. With this in mind, let's compare two approaches: waiting for forms versus acting immediately. On the left, waiting for forms seems convenient but risks missing key deadlines and can lead to repeated 6% excise taxes for every year the excess remains. Additionally, your CPA cannot file an accurate correction without proof that the ROE was completed. On the right, acting immediately by requesting the ROE enables removal of both the excess and its earnings, provides documentation to your CPA, and helps minimize penalties and confusion. With that comparison made, let's check your understanding with a second quick quiz. Question: in which year are the earnings from a return of excess contributions taxable? Options are: A. the year of the original contribution. B. the year you receive the ROE distribution. C. the following year after 5498 SAT arrives. D. they are never taxable. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the year you receive the ROE distribution. The earnings portion from the ROE is taxable in the withdrawal year and should be reported on Schedule 1. Next, let's add a practical action checklist so you can confidently move forward. Use this checklist to execute. First, audit your eligibility month by month. Second, compute the excess contributions precisely. Third, request the ROE immediately rather than waiting for forms. Fourth, track and save every piece of documentation from your custodian. 50. Deliver the 1099-SA and relevant details to your CPA. Sixth, file Form 8889 and report the earnings portion on Schedule 1. Finally, retain Form 5498-SA when it arrives for your records. Before we wrap up, let's include an important disclaimer to keep expectations realistic. This content is for educational purposes only and does not constitute tax, legal, or financial advice. Your circumstances may vary, and tax laws can change. Consult a qualified CPA or tax professional who can apply the rules to your specific situation. With that noted, let's summarize the key takeaways so you can leave with confidence. Here are the essentials. First, HSA eligibility is binary and requires HDHP coverage with no disqualifying secondary coverage. Second, excess contributions incur a 6% excise tax every year until fixed. Third, the ROE must remove both the excess contribution and the earnings. Fourth, the correct forms 1099 say 8889, Schedule 1, and 5498 say must be handled properly. Fifth, the earnings portion is taxable in the year withdrawn and must be reported on Schedule 1. Finally, act fast and do not wait for forms to start the correction. To close, let's wrap up and invite you to engage with the channel. We have covered the HSA tax trap, how to avoid it with a proper understanding of eligibility, and how to fix mistakes promptly through a return of excess contributions. You now understand the forms involved, the information flow among the parties, and the timing that keeps penalties in check. As we finish, here's how you can stay connected and help others avoid these pitfalls. Thank you for watching. If this video helped you, please like, share, and subscribe so more people can avoid unnecessary penalties. Leave your questions and experiences in the comments, and let us know what topics you want us to cover next.